Adjustments or changes to general ledger accounts are called adjusting journal entries. Before we prepare financial statements, we need to ensure that all accounts have correct balances. This will ensure decision makers have access to accurate financial information. Adjusting entries are based on 3 generally accepted accounting principles. They are the time period principle, the revenue recognition principle, and the matching principle. Time period principle assumes that an organization's activities can be divided into time periods such as months or quarters. These time periods are called accounting periods or reporting periods. Many businesses prepare interim financial statements, and interim financial statements are reports that are prepared before the company's year-end financial statement. If you look at the timelines indicated on the slide, the middle timeline shows us a typical calendar year. Remember, some companies can choose to have calendar years, or they can have a fiscal year ending in a different month, but they have to have a 12-month period of time as their fiscal year. When you look at the timeline, we can divide the time periods up into months, so that if a company chooses to, they can report their financial information monthly. We can have quarterly reports, and that means every 3 months. So if we looked at a calendar year, a quarterly report might be from January to March. A company can do semi-annual reports, and if we were working on a calendar year, the first report, interim financial report, would be prepared in June, and the final report would be prepared in December. And then some companies choose to only prepare financial statements once a year. The second generally accepted accounting principle that affect adjusting journal entries is the revenue recognition principle. This principle is an important one that was introduced in the first unit. This rule states that a company must record revenues when goods are sold or services are provided. The company does not need to be paid for its work in order to recognize a revenue. Let's say that ABC Company has a December year-end and wants to prepare an interim financial statement ending in June. So if we look at this timeline, the ABC Company wants to prepare an interim financial statement for the first 6 months of the year. Let's say that they sold a computer to a customer in June 2009 for $900. So we have a sale here for $900, and the customer didn't pay the company for the computer until October. So we're going to receive cash of $900 in October. So when you look at this transaction, we need to decide when we're going to record the revenue in the books of the company. And according to the revenue recognition principle, we record the revenue when we've provided the goods and services to the customer. So the sale would actually be recorded in June. We would also have to do a journal entry in October, but not for revenue. The journal entry in October would record the receipt of the cash. So the journal entry here would be a debit to cash and a credit to accounts receivable, nothing to do with revenue. The matching principle states that expenses must be reported in the same period as the revenues they help to earn. If we look at the previous example, the computer sales revenue was recorded in the month of June. All of the costs associated with selling that computer, like the cost of the computer, let's say it's for $400, and wages of $100, and advertising of $50, all have to be recorded in June, regardless of when those expenses are paid. So if we don't pay for the advertising until August, we have to remember that that advertising expense still has to be recorded in June. Prepaid expenses are the first type of adjustment that we're going to have a look at. Other adjustments will be discussed in later sessions. Prepaid expenses are expenses that were paid for in advance of using them. Examples of expenses that usually get paid for in advance are insurance, rent, subscriptions, and supplies. Here's an example of a prepaid expense called prepaid insurance. The company wants to prepare February 28th financial statement. It's really important that you're aware of the date that you're making the adjustments. So I'm going to remind myself that this is where we're going to make the adjustment by recording it on the timeline. When you look at the example, it says on January 1st, a company purchases an insurance policy that covers 3 months and costs $1,800. So in January, we have a prepaid insurance account with $1,800 on the debit side. Debits make assets go up. So prepaid insurance, remember, is an asset. And when we go to prepare our financial statements in February, we have to make sure that this asset reflects the correct amount. So what we need to do when we analyze the prepaid insurance account is find out if any of that insurance has been used. If we have used any of our prepaid expenses, they turn into expenses. So if we have used any of this insurance, it's going to turn into an insurance expense account. So what we have to try to do is figure out if we've used any of. So when we look at the $1,800 premium, we know that that premium was for 3 months. If we divide 3 into the $1,800, that equals $600. And what the $600 represents is our monthly insurance cost. So if we put that information on the timeline, we would have used $600 in January, we would have used $600 in February, and we would have used $600 in March. When we're making our adjusting journal entry, remember we're making it as of February 28th, we have to figure out how much was used. And when we look at the timeline, it shows that $1,200 of the insurance has been used. When we go to prepare our adjusting journal entry, we want to take that $1,200 out of the prepaid insurance account with a credit, and we know that we have to debit something, and we debit the insurance expense account. So our adjusting journal entry is a debit to the insurance expense for $1,200 and a credit to the prepaid insurance account. Office supplies is another example of a prepaid expense. When we make adjustments to any prepaid expenses, we are having a look at what's in the account at a specific point in time, and we're determining if any of that expense has been used. If any of the office supplies have been used, it can't stay in that asset account. It has to be transferred to an expense account, and we call the expense office supplies expense. So we need the details to figure out how much of the supplies that we've used so we can transfer to the expense account. So let's have a look. Office supplies were purchased in February at a cost of $800. So on our timeline, the $800 was put into this office supplies account in February, and it goes in with a debit when we purchase office supplies. At the end of March, so that's when we want to prepare our interim financial statements, an inventory of supplies showed $250 of supplies on hand. So when we look at our office supplies account, we say, okay, do we have $800 for supplies on hand? No, we don't. We only have $250. So we have to figure out how much of those supplies were used. So we're going to take the $800 of supplies we started with, subtract off what we have on hand, and that will give us how much we've used. So that's the number that goes in the adjustment. We have to take $550 out of the office supplies account with a credit because we want to make that office supply account go down. And that means we have to debit something, and we always debit an expense when we're dealing with prepaid. So we're going to debit office supplies expense for $550. So in our adjusting journal entry, our debit is to office supplies expense and a credit to office supplies. What we're doing with adjusting journal entries is we're transferring amounts from one account to another to ensure that both of them are reflected correctly in the financial statements.